Welcome to the GCV Weekly Briefing Podcast, where we break down key financial and economic developments shaping the landscape for UK investors, businesses and policymakers. I'm Matthew, and this week we're looking at 4 stories, from the deepening slowdown in manufacturing to the OBR's latest economic outlook, the ongoing pressure around inheritance tax, and recent changes to venture capital incentives. There is a lot to cover here, so let's get started. The latest CBI survey shows a sharp deterioration in the UK's industrial picture. Manufacturing output in the 3 months to November fell at its fastest pace since the pandemic. The weighted balance dropped to minus 30% from minus 16% previously, and well below the long-run norms. It reflects reports from firms across the sector. Demand has softened, costs remain high, and broader policy environment is still unpredictable. Order books do back that up. Both total and export orders are well under historical averages, and stocks of finished goods remain above what firms consider adequate. That usually means weak pipelines and an overhang from earlier front-loaded production as companies try to get ahead of possible tariff or tax changes earlier in the year. There were 2 small positives here though. Expectations for average selling price inflation eased back towards long-run norms, and some economists linked that cooling to the possibility of a December interest rate cut, which backs up what we were saying last week. For investors watching Bank of England decisions closely, that's a relevant shift. Official production data has also been just as downbeat. ONS figures confirm a 0.5% fall in industrial output in Q3, including a 2% drop in September alone. Part of this was due to that cyber attack that hit Jaguar Land Rover, but business groups say that the bigger issue is policy uncertainty. The risk of further fiscal tightening is weighing on investment at a time when manufacturers say they can least afford it. Moving to the OBR's latest outlook, it presents a mixed picture. Growth this year is still stronger than expected, and its estimate for 2025 has been revised up to 1.5%, but beyond that, the outlook softens. Projections for 2026 through to 2030 sit between 1.4% and 1.5%, which is lower than earlier forecasts. The main issue, as you may already know, is productivity. Expected productivity growth has been cut by 0.3 percentage points. On its own, that would remove about £16 billion from future tax revenues in 2029 to 2030, although higher inflation-linked tax receipts partly offset the hit. This slowdown comes at an awkward time for the government that's placed economic growth at the centre of its agenda. The OBR says business and consumer confidence remains subdued, supposedly held back by global conflicts, uncertainty around trade and supply chains. That caution is already showing up across the industries, including the manufacturing slump we just mentioned. After the budget, taxes are set to rise to record levels by the end of Parliament, driven mostly by the continued freeze on income tax thresholds. By 29/30, the OBR expects around 780,000 more basic rate taxpayers, 920,000 more higher rate taxpayers, and around 4,000 more additional rate taxpayers, purely through fiscal drag. Public spending will also increase each year, helped by welfare changes such as reversing previous cuts and lifting the 2-child limit in universal credit. These forecasts matter for households, but for the Chancellor, whose fiscal rules require day-to-day spending to be fully funded and debt falling as a share of GDP by the end of Parliament. Reeves now has £22 billion buffer, twice the previous one, but keeping that credibility depends heavily on productivity improving and global pressures easing. Neither is guaranteed. Still, the political message remains upbeat. Reeves argued that the UK had already beaten this year's forecast and would continue to outperform. But, as Yael Selfin for KPMG said, the factors driving that growth may be out of the government's control, decided by the largely unknowable impact of new technologies. Moving now to previous taxation, HMRC data shows how quickly inheritance tax receipts are rising. £5.2 billion has been collected in the first 7 months of the 2025/26 year, £0.2 billion more than the same point last year. It continues a long upward trend driven by frozen thresholds, rising asset prices, and tighter exemptions included in the 2024 autumn budget. The recent budget reinforces this pattern. A number of last year's reforms have not actually taken effect yet, leaving households exposed to changes that are actually scheduled but not yet felt. Advisors are encouraging families to get updated valuations of their estate, especially property, to understand their true position. Inheritance tax is shifting from a niche concern to a pretty mainstream one. House prices have risen significantly over the past 2 decades, pulling more estates over that nil rate band without families making any major change to their assets. This ties directly into concerns raised in the previous section around future tax pressures. Because the rules are becoming more complex and more political, professional advice is now considered essential. Families are dealing with moving policies, uncertain timelines, and a fiscal environment under a lot of strain. Stephen Lowe of Just Group summed up the situation clearly. Estate planning is more complex and difficult, and it's not made any easier when the rules are changing. Many families who wish to manage their estate effectively will benefit from professional advice. The final story this week focuses on venture capital. The Chancellor has announced major changes affecting the UK's investment ecosystem. VCT and EIS investors will be allowed to invest larger amounts into more mature, faster-growing companies. The intention is to improve the availability of later-stage capital growth for higher-growth firms. But most of the attention has fallen on the cut to the upfront VCT income tax relief, from 30% down to 20%. For investors, this reduces the incentive to support higher-risk, earlier-stage businesses. History supports these concerns. When the relief fell from 40% to 30% back in 2006, VCT fundraising dropped by about 2/3 and took more than 10 years to fully recover. Critics argue that increasing the limits on what VCTs can invest in is meaningless if funds can't raise the capital in the first place. With pensions still offering up to 45% tax relief, money may shift towards lower risk products, which runs against the government's stated ambition to support growth-focused innovation. With VCT relief now less competitive, some also expect that the capital will flow towards the EIS instead, where the 30% income tax relief remains intact and continues to offer strong compensation for early-stage risk. The Treasury expects to raise around $120 million by 2027/28 off the back of these changes. But industry figures say that the gain is too small to justify the broader economic hit. The risk is that companies between the seed stage and mainstream private equity, often firms with the strongest growth prospects, will find it harder to secure funding. Callum Pickering of Peel Hunt really didn't hold back, calling it a stupid change, the one major negative in an otherwise tolerable budget. Across all 4 stories, the theme is clear. The UK enters its next phase of fiscal and economic decision-making, with rising tax pressures and limited room for manoeuvre. Manufacturing is under strain, long-term growth forecasts have softened, inheritance tax receipts are rising, and early-stage investment incentives have weakened in some areas. Each issue stands on its own, but together they shape a picture of an economy adjusting to slower productivity, tighter public finances, and shifting policy. That's all for today's update. Thank you for listening.